So, Jonathan, we were talking during the break. Underweight U.S.,
yes.
Overweight this part of the world. Just help us understand the broad thinking there, one.
Well, it's divergent economic growth paths, particularly out of China, but also the countries that trade with China, like Korea and Taiwan, doing a lot better than the United States. And with that goes divergent earnings growth revisions. So we are seeing a trough in earning estimates revisions that's starting to unfold here in Asia, just at the time as our colleagues in the US expect significant further downside in earnings estimates there.
That PMI number that China released, I think it was just about a week and a half ago, was substantially higher than what the market expected here. I mean, to your point, really, in earnings revisions, where are you starting to see, which specific markets that is, starting to see really that trough, if you, or pick up in some cases, if not?
Well, I think the key to this China recovery is the consumer, both in services and in goods spending.
Okay.
And that's where we're seeing it starting to form already. And then for the big cap tech stocks, where the earnings estimates revisions were really very bombed out in the third quarter into the fourth quarter, they've actually stabilized as well when we're looking out to 2024. And obviously, as we move through the year, it's 2024 that matters the most.
Jonathan, apart from China, what about the rest of emerging markets who are bracing for more volatility, at least in the short term, with the Fed data-dependent, not just data-dependent, but collectively, in total? I mean, what does that mean for EMs?
Well, one point that we've made together with our fixed income colleagues is that sovereign balance sheets across emerging markets are in a much stronger position than they were in previous Fed hike cycles. So we have had some problems in relatively low quality EM sovereigns already going to the IMF and such like, but they're not mainstream equity index constituents. And indeed, last year, throughout most of the initial phase of the Fed hiking cycle, we were bullish on markets like Brazil or Indonesia that you wouldn't typically be bullish on in a Fed's hike cycle. We've actually scaled those back to go fully into our North Asia ex-Japan call, the China, Korea and Taiwan call I was talking about earlier. But we're not anticipating those sort of sovereign issues that we had in the past. And indeed, EM sovereign debt spreads, they widened up until July last year, but they've been broadly actually tightening since then.
I just want to read you what's happening in the Treasury market. Of course, we're seeing that angst, in particular in the bond market. 2-year Treasury yields extending its slide to 10 basis points right now. How might this play out in Asian markets, Jonathan?
Well, I touched on this earlier. It's tremendously important, I think. But this sudden kind of bull steepening in the US curve is quite indicative of a moment having arrived where investors are really questioning whether the slowdown is biting in the US. And I think what that means is it further firms up the case actually for rotation out of US assets, US equities, which is our call, and into a part of the world where, you know, we went through some very significant problems in Asia and EM in relation to earnings revisions last year. They fell about 25 percentage points as China's slowdown was so severe. But we're in a different place now. You really have to go back to 2009 to find such a sharp divergence, with Asia actually getting through its problems and really kind of recovering very strongly at the same time as the US was still sort of working through its issues.